Hello everyone, welcome to Demand Supply Trading Practical session number 42. Myself, Srijit Kakar, and today is Saturday, 2nd of November 2024. Now, generally, I do these sessions on Sundays, but tomorrow, unfortunately, I'm not available. So, I had two choices either to do the session today or altogether skip the session for this week. So, I thought doing a session today would be a better option. At least, we'll not be missing the very first session for the month of November. So yes, that's why we are doing the session on Saturday. Otherwise, generally these sessions are always on Sundays. Now, before we move ahead, let's also get done with the basic formalities. Make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we have recently started a channel on Telegram where we keep updating you regarding when these sessions are happening, if we have any offers coming up, if we have any promotions coming up. So in case you are interested in joining the session, and the channel, if you are interested in joining the channel, the QR code is available on the screen. You can also find the direct link in the description. You can click on that link and you can join this channel. Otherwise, you can also search for trading demand supply on Telegram. You'll be able to find our channel and you can join it. Now, today's session is practical application of demand supply methodology. So our demand supply course, which used to be a paid course, is now available 100% free. Everyone and anyone can learn the methodology. The link to the course content is available in the description. You can go through the course, which will help you understand what is demand supply methodology, how to identify these areas, how to qualify these areas. But the challenge is that when you go through that course content, it basically covers the methodology theoretically. But unless and until we look into some practical examples, at times we don't get a very good understanding of how it has to be applied. And that is what we do in these practical sessions. So every weekend I do a practical session where we take some examples, and to those examples we apply the complete process so that you can understand how to plan trades very mechanically, very rule based. Now, the best part about these sessions is that I'm not picking something which has already happened and simply reviewing it, because that's a piece of cake. Anyone can do it. You can pick any chart, you can apply any indicators, oscillators, a move which has already happened. It's very easy to justify, okay, this could be the reason because of which I would have bought, or this is the reason for which I could have sold. But the real beauty is when you're doing the analysis well in advance, which means you have no idea what is going to happen in the future, and you do your analysis. That is what we do in these sessions, because the beauty of demand supply methodology is that things can be pre-planned, and that is what we are doing in these sessions. We are pre-planning the areas where we would like to be buyers and sellers, and whenever prices they revisit these areas of demand supply sometime in the future, that is the time those trades they get triggered. So these sessions, they basically help you see both the before as well as the after. Before, why? Because we are planning the trades in advance, and whenever they get triggered, I also share the review after they have got triggered, right? So that helps you see both the before as well as the after, and that in a way helps you build confidence in the methodology. And that is what these sessions are all about, because unless and until you have confidence in a methodology, you will probably not be implementing it or trying to learn it. But once you see it working in real life situations, right, that is why we take real life examples, you get more confidence in that methodology, and that is how you slowly start shifting towards demand supply. Or maybe if you're doing some other strategy, you start maybe incorporating demand supply as a confluence. So yes, we do have one trade which was getting carried forward for us, so we'll start with the review of it. But while we are reviewing it, I will also review the other 3 4 trades which we talked about the previous session. And the reason I'll do that is because there is one challenge, and that challenge is that most of the trades, in fact I'll say all of the trades that I share with you people, are MIT trades, right? So MIT means a trade which can last for a month or few months. Now what happens is, if the trade gets triggered in this week and I share it in this week itself, so probably it will only get a max of 4 to 5 days, right? Because even if it gets triggered on Monday, so you only have Monday, Tuesday, Wednesday, Thursday, Friday, which is 5 days. So a trade which can take from a month to few months, and we are only reviewing it within 4 to 5 days at times, does not show us the beauty of demand supply methodology, because we can probably see a very small move which has just happened. The bigger move might happen eventually. So that is the reason I just want to again touch upon the ones which we looked into the previous session as well, so that you can see that how they have also worked out. Probably I'll also show you some examples from the past that I shared with you, so that you start seeing that yes, uh, people say it's impossible to I won't say impossible. People say we should not be catching the falling knife, but if you have the skills, if you know how to do it, yes, you can, catch that falling knife. And that is where your reward will always be the highest and your risk would always be the least, right? But people, they generally avoid it. Reason being, they are not aware of such a methodology or such a strategy. All right, so let's get started with the reviews, and then we'll start with the today's examples. So the first one I want to start with is the one which was getting carried forward for us. So just give me a second. Let me bring that up for you. All right, so this was session number 38. The session was on the 6th of October, and we came into the zone on the 22nd of October. You can see we definitely went a little deeper into the zone, though the distal line has been breached, but our stop loss was not hit. And you can see we have already started moving up. This will still remain as an open trade for us, because in this, I guess we were looking at a target which was about close to 3:1. We have still not achieved it. We don't even have violation of an opposing zone. In fact, we do have a violation of an opposing zone, which is this rally based drop, but the new demand which has formed still keeps our stop loss at the original location, right? So there is no modification as well. Yes, once it reaches the 1:1 mark, we can probably make it as a break even trade. So this will still remain as an open trade for us, and we'll track it for the next few sessions unless and until we get an exit on this. Now, talking about the other few, if I just go through them. Just give me a second. Right, so this was session number 24. We did the session on 23rd of June, and the prices came back into the zone on the 8th of October. You can see we already got a move which was 1:1, 2:1, pretty close to 3:1. Then we again came into the zone. We have been hanging around there. We have again started moving up from there. So the reason I'm showing you this is because, see, like I said, it's an MIT trade, and an MIT trade can take a month to maybe few months before the trade plays out, right? So if you look at the same trade after few months, we might be doing something like this. We might be at 8:1, 9:1, or something like that, right? But the problem here is that I can only review the trade during that week itself. I can't, keep reviewing the same trade for X number of months. So that is where my challenges are. But I just wanted to show you the markets were pretty bearish, and you can see the very first two examples we just reviewed. The prices stopped at our demand areas, and that is where they have started moving up from. In fact, for some of them, we have already got moves which are more than 2:1, and we are still getting multiple reactions from those areas of demand. All right, now let's look at another example, which was again the one which we reviewed in the previous session. So this is again a example that we previewed in the previous session. Here also you can see this was session number 40. We did the analysis on the 20th of October. We came into the zone on 22nd, and you can see the very next day we got a move which was almost 4:1. Then again we came into the zone. Again we are getting reaction from the same area, and you can see price exactly stopped at the demand area that we identified for ourselves. So again, the reason I'm showing you these examples is so that you people start building up confidence in the methodology. All right, now let me show you another one. All right. Now this is from session number 33, which we also reviewed the previous session. Here also you can see we came into the zone, and now we have already started moving up. We are getting pretty close to about 2:1. And what I'll also do is I'll also go through some of the examples from the past, so that you can see how the methodology has been working for us. So this was our very first session for this year, which was session number 1. You can see we haven't got the fill on this as of now. We are still waiting for the fill, but yes, we have already got a really nice move from here. So we'll have to re-verify at the time of entry. Probably the move which we were waiting for has already happened. This is your session number 12. You can see we came into the zone. Currently, we are trading somewhere around here. So again, like I said, when we would have done the review, probably that time you could only see maybe a 1:1 or a 2:1. But because these trades can last for a month to maybe few months, so you can see from the time of entry, which was back in June, till today, we are somewhere around, maybe if this is my 4:1, this is going to be 8:1, this is going to be maybe 12:1. So we are trading somewhere close to 15:1, right? So this is your session number 12. This is your session number 13. Here also you can see we came into the zone. And again, when I would have done the review, probably in the next 4 to 5 days, we would be somewhere around 1:1. But if you look at it today, Even today, we are trading somewhere around, maybe if this is 4, we are close to maybe 7 is to 1, right? Otherwise, we have already got a move which was maybe a 10 is to 1 kind of a move, but we are still about 7 is to 1 on this one. So I'm just showing you a few examples from the previous session so that you people can see. Can you see? We exactly stopped at our demand areas. That is where we started moving up from. Now, this is session number 18. We still haven't got the fill on this one. This is session number 21. You can see we just touched the zone and you can see an amazing move. Probably we are at about maybe 20 is to 1 or maybe even more than 20 is to 1 on this one. So again, a beautiful example from session number 21. This is session number 24. I guess we just reviewed it some time back. This is session number 26. You can see we came into the zone. We got a move which is maybe an 8 is to 1 or maybe a 10 is to 1. And even if you talk about as if now we are trading almost close to 8 is to 1 on this one as well. And again, you can see where did the price move up from. It just touched our demand area and how beautifully prices reacted from those areas of demand. So again, the reason I'm showing you these examples, plus, if you go back to these sessions, the reason I'm giving you the name of the sessions is because it's not that I have marked these zones today, right? You will see when we were doing the analysis, the chart would be something like this, right? So we pre-planned it and eventually prices came into the zone and how beautifully prices are working from those areas of demand and supply. All right, let's look into another example. So this one is from session number 27. You can see we came into the zone. We got a really nice move. We again came pretty close to it. No, I think we are still waiting for this one. So this probably would be a case of maybe level on top of level. All right, 28. We haven't got the fill for now. Session number 37. You can see again, we came into the zone. We got a really nice move. Again, it came into the zone, just hanging around there as of now. So we have already got a move which is more than 3 is to 1 on this one as well. If you look at the next one, 38, we just reviewed, right? Then we have session number 40, which we also reviewed. And then we have 41. We haven't got the fill for the session number 41 as of now. And today we'll be on session number 42. So we'll be doing the analysis for this one. So again, the reason I showed you some of these examples is because you can see on some of these examples, we are at 10 is to 1. Some of them are 20 is to 1. Some of them are 8 is to 1. Some of them are 7 is to 1. So if you just look into this as an example, you can see that how beautiful these reward to risk ratios are, right? Obviously, we also had some stopped out trades, but these kind of reward to risk ratios, they definitely take care of your stopped out trades as well. And that is why I always keep saying that the key to profitable trading is never the hit rate, right? I might have a hit rate which is 90%. I can still be a trader who is net a loser. Why? Maybe because I'm risking a very big amount to make a very small amount, right? So that is where even if you have a 90% hit rate, you might not be a profitable trader. But if you have beautiful reward to risk ratios, you might be right maybe only 20% of the times, but you can still be a net profitable trader as long as your reward to risk ratios are in place. So that is why I just wanted to touch upon some of these examples. And like I said, the challenge here is I only trade MITs. And for MITs, we have to give some time for the trades to play out. And I can't review these trades almost every other week. So we are only reviewing it probably the same week or unless and until we get an exit on that. And that is why I thought, let me just touch upon it and show you the beauty, especially because I wanted to show you that the last week when we did the review, we got fill for about 6 examples, out of which 2 were stopped out. And the rest of the 4, you can see they worked out really, really beautiful. The zones are still holding. Some of them were 3 to 1 bounces. Some of them were 2 to 1 bounces. Some of them were 4 to 1 bounces. We again came into the zone. The zones are still holding. So it's not that we cannot plan trades in advance. We can definitely do it. That is what this strategy proves. And again, like I said, if you know how to catch that falling knife, that is where your risk would be the smallest and your reward will be the biggest. And that is what these examples they show you. All right, so let's get started with our analysis for today, and then I'll take the queries we'll be having in the chat box. So whatever questions, queries you have, you people can start putting into the chat box. I'll take those queries at the end of the session once we are done with our analysis. So when it comes to trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. In case you have not yet watched the video, the link is in the description. Make sure you go through that video, watch it, follow the process that I've explained in that video. There is no bypassing it. Eventually, you will have to go through that process So the sooner you go through that process, the better it is going to be for your trades. So do ensure you watch that video, follow the process. Now, yes, we need to be mechanical, we need to be rule based, but the problem is if I've just started learning how to trade, or if I'm learning demand supply as a new methodology, it's not very easy that from the very first day I can create a trade plan for myself. So that is why what I've done is to help you through this process. I have created a ready-made trade plan for you, which is a combination of two documents. The first one is your trade plan steps, which basically guides us what we need to do as a demand and supply trader step by step. And all these steps, they have their own elaborate rules, which are available in the rule book. Now, mind it, this rule book that I've shared with you is a conservative approach, because whenever we are learning something new, definitely makes sense to start conservatively. As you start having more and more experience, if you want to modify this to make it better suit with your personality style, those modifications can definitely be done, but at least you do have a starting point using which you can start planning your trades. So what is my step number one whenever we start planning our trade? Step one is we need to define our trade purpose. And what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade, and the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be uh, the break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why are we starting with trade purpose as our step number one? And the reason we are doing that is because when we do our analysis, the charts that we use, they are time based charts, and we have a number of time frames available to us. So the very first challenge is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frames. We start again with a very logical approach, and that logical approach is the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into four different purposes. We call them as hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income is a trade which can last for a month or few months. Now, very important, by definition, I say daily income is a trade which can last for a day or few days, but you need to understand that if you're trading markets which are not 24-hour markets, there I'm pretty sure you would have experienced whenever the market opens, some symbols they gap up, some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you also might lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight, by holding that position overnight, we are taking that unnecessary overnight gap risk. And that is why my recommendation to all of you is that initially your hourly dailies should be done as strictly intraday trades if you're trading markets which are not 24-hour markets. For weekly monthlies, we have no choice. We'll have to keep these positions as overnight positions. But that does not mean that for weekly monthlies we cannot have gap against us. It can still happen. But since we are leaning against some bigger time frames, the probability reduces. Plus, for weeklies and monthlies, your zones are also a little wider. So even if there is a gap against you, it might not go beyond the zone. It might just gap a little deeper into the zone, and which is where you're still a little protected. But yes, with time, with experience, if you want to include the daily incomes into overnight trades, that can be done. It's just that initially, as a risk management rule, to avoid that unnecessary gap risk, we would not do daily incomes as overnight. So step one is I need to define my trade purpose. Let's assume I opted, I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? Now from the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 in the rule book, we start with a topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the high time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries like your type 2, type 3 entries, or in case you need to apply some additional rules, that is also where this time frame can help you. Next, what are the four different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question is, for every purpose of trade, what will be my four different time frames? And the answer comes from this table, which is on page number 31. Now, mind it, this table is specifically for the NSE market because it is only open for about 6 hours and 15 minutes. But if you're trading markets which are open for longer duration, then you can refer to page number 32, where you have this table, and this can be applied for commodities, forex, let's say cryptocurrencies, right? So whichever markets that are open for longer durations, you can refer to this one. Otherwise, for NSE, you can refer to this one. Now, because I opted, I want to plan monthly income trades. From this table, I got to know my time frames. My time frames will be monthly, weekly, daily, and 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate, used for trend analysis. Daily will be the lower time frame. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case we need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using plus what analysis I'll be doing on each and every time frame. So my challenge number 1 is taken care. The next challenge is, yes, I do know my time frames, but if we take the example of the NSE market, you can see on the NSE exchange we have about 2000 plus companies listed. So humanly not possible that every day I sit and analyze 2000 companies. So what I need to do now is I need to get a smaller list out of these 2000 companies so that I can do my analysis almost every other day. So how do I get that smaller list? So for that, we use certain computer programs which are called as scanners or screeners. So for the script selection process, what these scanner screeners, they basically do is that we input certain conditions into them. These are the conditions I'm looking for. And then the scanner screener will identify which all symbols are matching with these conditions, and whatever is matching with those conditions, it gets shortlisted for us. Now, very, very important thing which you always have to remember, irrespective whatever scanner or screener you might be using, whatever results you get from these scanner screeners, you can never blindly buy or sell those symbols. The scanner screeners, they never tell you what you need to buy or sell. The scanner screeners only help you get a smaller list out of a bigger list. Once you have that small list, you'll have to analyze them manually one by one. Whatever matches with your trade plan might be your trading opportunity. Whatever doesn't match with your trade plan has nothing to do with you, right? So always remember, scanner screeners, they don't tell us what we need to buy or sell. They only help us get a smaller list out of a bigger list. Now, a few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created some scanners for you which are based on some moving averages. Using that, you can shortlist some symbols. Second example, on my YouTube channel, search for scanner, and you'll be able to find few scanners, different videos. If you like any of those logics, you can use that for shortlisting symbols for yourself. Third example, on my YouTube channel, search for sector analysis. You'll find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll be able to find a video on top-down analysis, which can again help you in shortlisting symbols. So these are 3-4 different examples of scanner screeners which can help you in shortlisting symbols. So let's look at few of them before we move ahead so that we can understand this step as well. So like I was talking about, that once you come to my website, under the free tab, you have a stock screener option. Because I want to plan MIT trades, I can click on MIT. I can run the long scan and the short scan. So here you can see the long scan is shortlisting 8 symbols for me, and the short scan is shortlisting 2 symbols for me. So in totality, I got 10 symbols to look into. Now, very, very important, like I already said, just because I got these 8 symbols from the long scan does not mean I will blindly buy these 8. Similarly, just because I got these 2 symbols from the short scan does not mean I will blindly sell these 2. So what happened now is, out of 2000 plus companies, I got a list of 10. So I'll have to analyze these 10 one by one manually and see which one of these match with my trade plan. Whatever matches with your trade plan, that might be your opportunity. Others you will skip. Now, at times what can happen is your list can be a very small list, like you can see today, or maybe at times the scanner is not generating any results for you because nothing is matching with these conditions. So the problem is, the smaller the list, the lower is the probability you might be able to find something which is in sync with your trade plan. So if you want that the scanner should always throw a little bigger result for you, then what you can do is, you can see that I have given 5 different conditions in the scanner. You will disable the third one, you will run the scan again, and I'll do exactly the same thing for the short scan. I'll run the scan again, and I'll do exactly the same thing for the long scan. So if you want that the scanner should always throw a little bigger result for you, then what you can do is, you can see that I have given 5 different conditions in the scanner. You will disable the third one, you will run the scan again, and I'll do exactly the same thing for the short scan. I'll run the scan again, And now you can see initially it was giving me a result which was 8 symbols, but now it is giving me around 62. And if I go to the short scan, it is giving me how many? 46. So we have 62 plus 46, which is 108 symbols to look into. So you can see that we got a list of about 108, which is not a very big list. I'll say 108 can be easily analyzed in about half an hour, 45 minutes. But if you still feel that it's a very big list, you further want to filter it out, you can use different filters. Example, I can say I don't want from the cash segment. I only want the ones which get traded in futures. And now you can see from 64, I'm down to 26, right? So this is how you can make your list bigger. You can make your list smaller. Plus, if you go to the screener section on this website, you will see you have over 150,000 scanners available on this particular website. Few of them are based on fundamental analysis. Then you have your top left, then you have candlestick patterns, then you have range breakouts, you have your bullish scan, you have your bearish scan, you have intraday bearish, intraday bullish crossovers. So you have a number of scanner screeners available to you, and this is an example of one website. If you'll do a Google search, you'll be able to find a number of websites and number of scanner screeners. So in this example, you saw we got a list of 108. Sorry, 108. Now, once you start analyzing these symbols, a few challenges which you will realize. Challenge number one, what you'll face is that you will realize that the majority of the symbols in this list, they don't have a quality demand zone or a quality supply zone on them. And now the problem is that as a demand supply trader, unless and until we have a quality zone, we cannot plan a trade. We need a quality zone to plan a trade. So this is where you might be wasting a lot of time analyzing such symbols where nothing tradable is available to you, and few symbols which might have some quality demand supply areas. Those quality demand supply zones might be far away from the current market price, due to which you'll have a longer waiting period, because unless and until prices they come back into your zone, you can't participate. And during that waiting period, whatever price action develops, it might even disqualify the trade setup by the time it is back into your zone. So we understand that these are some of the challenges which we might face when we are using scanners which are based on either conventional technical analysis or fundamental analysis, because all these over 150,000 scanners I talked about, none of them are based on demand supply. They are either based on conventional technical analysis or they are based on fundamental analysis. And to overcome these challenges, we have also created two custom built scanners which are called as the alert service and the screener. The first thing I'll add here is very, very important. These are not call giving or tip giving services. These are also scanner screeners. But the only difference is that these two scanner screeners are purely based on demand supply zones. So if you want to have more information about them, the link to the walkthrough videos are available in the description, but I'll briefly touch upon it so that you can quickly understand what they basically do. So the way alert it basically works is that it keeps updating you during the live market as and when we have formation of demand and supply areas. Now for the alerts, we have two ways. One, we have a predefined list for which we send you alerts. Plus you can also set your custom alerts by using our indicator. So if I just want to show you example, we do have demo channel for the alerts available. So I'm showing you the example from the NAC demo channel. So you can see this is for 31st of October. You can see at 11:15 for this particular symbol, we have a rally based rally zone on the 5-minute chart. This is the proximal value. This is the distal value. So this is what alerts they basically do, that during the live market, as and when these demand and supply areas are getting formed, it immediately notifies you real time live that on which symbol, on which time frame we have a formation of a demand or a supply area. Now, very important, just because you're getting these notifications does not mean you can blindly buy at these demand supply zones. The job of the scanner is only to shortlist and tell you, okay, this is where a zone has just formed. Then you'll have to match that zone with your trade plan. Only if it qualifies based on your trade plan, it can be an opportunity for you. If it doesn't qualify based on your trade plan, you simply skip it. So that is alerts, that it updates you during the live market as and when the zones are getting formed. The other tool we have is called as the screener. And the way the screener basically works is that we again input our list into the screener. So here you can see I've given a list of 40 symbols. And then I've told the screener I want you to shortlist symbols where my proximity is 1%, which means out of these 40 symbols, wherever my current candle is 1%, within 1% to a demand area or a supply area, shortlist it for me. And you can see out of 40, it is telling me if you want to plan a long trade, you only have Bharti Airtel to look into. And if you're looking for a short trade, you can look into BPCL, right? So can you see? And this is what the scanner does for us. So if I go to Bharti Airtel, you will see that on Bharti Airtel, we are definitely close to this area of demand, and that is why it got shortlisted for us. And if I go to BPCL, you will see we'll be closer to a supply area, or we'll have a formation of supply zone on the current candle. So you can see we have a supply zone here, and current candle is pretty close to it. That is why it got shortlisted for us. So you can see that I gave a list of 40 symbols, and now I know what are these 40 symbols. I don't have to analyze the rest 38. These are the only two I can analyze because they are closer to demand supply zones. And if I just change the time frame, initially I was on the daily time frame, now I changed it to weekly, and now you will see it will give me the results based on the weekly. So you can have your results based on whatever time frame you wish to. But the difference is that alerts, they notify you for the zones which were formed today itself. But scanner, it will help you identify symbols where the current candle is closer to the zone, irrespective whether that zone was formed today or yesterday or a week ago or a month ago or a year ago. It takes into consideration the complete history which is available on TradingView while identifying those areas of demand and supply and your proximity to that zone. So yes, we have a number of ways for shortlisting symbols. I showed you over 150,000 scanners on one single website. I also showed you two scanners which are purely based on demand and supply. Process can also be as simplified as, I don't want to use these scanner screeners because I want a small list. I will only be analyzing my Nifty 50 stocks every day, or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours how you want to get that list. But yes, you will need to get a smaller list to move on to the next step, because if you are still having a list of 2000 plus symbols, it's not very easy to analyze it every other day. So wherever your process might be, apply that, get your smaller list, and once we have the list, now we have everything required to start with our analysis. Because from our step number 1, we got to know what time frames I'll be using and what analysis I'll be doing on each and every time frame. And from step number 2, I got to know which symbols I'll be analyzing one by one. So let's imagine the very first one was ABC. What am I supposed to do now? I need to go to the lower time frame. So question is, what is my lower time frame? And we got the answer from our step number 1, that as a monthly income trader, my lower time frame is daily. So I'll go to the daily chart, and on the daily chart, now I need to identify zone, and by zone we mean any of these 4 structures. It can be a drop based rally, rally based rally, rally based drop, or a drop based drop. Now the best part here is that we recently started with a 7-day free trial of our demand and supply zone indicator. Yes, you do have our free indicators as well, which is the boring candle indicator and the explosive move indicator. But like I always talk about, that the demand supply is much beyond the boring exciting technique. That's just a starting point which we use to start training our eyes. So if you want to try the demand and supply zone indicator for 7 days, the link is available in the description. You can fill that Google form, and once you fill that Google form, your access to the demand and supply zone indicator will get activated within 24 hours, and then you'll be able to try it out for 7 days. So because you and everyone now have the option to have a free 7-day trial while we do the analysis, will strictly be using the indicator, because that definitely helps make the process mechanical, faster and easier for us. So if I go to the chart, you can see the indicator is telling me I have a rally based rally here. Now, as if now the indicator is identifying this zone based on the rally base and this leg out, not because of the gap, but the indicator also has the option that I can say identify overnight gap zones. And can you see, once I do that, now it will not identify because of this candle. Can you see this candle now has been converted into a green color candle, but it is telling me that from here we did have an overnight gap, and because of that gap, so again, whenever you see a gap, just imagine that gap as an invisible candle between these two candles, right? So this is basically my leg out, which is this gap. This is not the leg out, but yes, even if we take this as a leg out, it is an explosive candle, and that is the reason the indicator was initially marking it. So I think this is maybe the first or maybe the second example for this year where we are taking a gap example, because gap zones, it's not very frequent we look into. So this one I specifically picked because of the gap. So yes, our step number 3 was to identify the zone, which the indicator is doing for us, and now we have marked that zone. So our step number 3 is done, which is identify zone. Do we have a zone available? The answer is yes. Once you have identified the zone, the next step is to qualify it. You cannot use any demand area or any supply area blindly. You'll have to qualify it, and for qualification, there is a 2-step process. Step 1 will qualify it based on certain conditions. Step 2 will qualify it based on the boosters. So the very first condition we check is that can this zone be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. And if you have been following these sessions, I'm pretty sure by now you would know how do we check level on top of level. So let's go back to the chart and see whether it is a case of level on top of level or not. So that's my lower time frame area. Once I go to my intermediate time frame zone, we can see that my lower time frame zone is not coinciding with any intermediate time frame zone. And since we don't have a coinciding level, it cannot be a case of level on top of level. So this is not a case of level on top of level. So level on top of level is not applicable. This zone is definitely because of a gap. So let's look at the gap rules. So the rules for the gap is one. The gap has to be an overnight gap and an open gap. So we can see this is an overnight gap. This day we closed and the next day we gapped up. So let's assume this was 100. We gapped up to 101. Just give me a second, please. So we definitely have a gap. And the second thing was it has to be an open gap. Now, what do we mean by open gap? So if we gapped up from 100 to whatever price, unless and until we come back to 100, this will remain as an open gap, right? So as of now, we have not been back to this closing price, which basically implies this is also an open gap for us. So our condition number one, which is it is an overnight gap, is applicable. It has to be an open gap, that is also applicable. Next, it also has to be a pro gap, and whether it is a pro gap or a novice gap, you should always be identifying it on daily time frame, nothing less than daily time frame, right? You can even go to a bigger time frame, but nothing less than daily. So how do we qualify whether a zone is a case of whether a gap is a pro gap or not? So the definition is that a gap in the opposite direction of the price is called as a pro gap. So if you look here, can you see we have been moving down and now we got a gap up, and that is what we define as a pro gap. Now, why do we call it as a pro gap? Because if you think about it, something which was trading somewhere around here right now went down to a low which is somewhere around here, and if you look into this in terms of percentage, you can see we were down at about 26%, right? So if you think about it, just like, you have your sales, if you have sale in the mall, people are just rushing to the mall to buy at a cheaper price. So it's exactly the same thing, right? Now we are getting the same stock at a 26% discount because of whatever happened in the last few weeks. Now, if you think about why did the price gap up? Now, the only reason for the price to gap up is that during the pre-market, even though we closed at 100, somebody was willing to buy a little expensive, because unless and until somebody is willing to buy expensive, prices can never gap up. Somebody has to place a real order that they are willing to buy at an expensive price versus wherever we closed yesterday. And why would somebody do that? Because maybe they already know they are getting at a cheaper price, they want a bigger fill, and the only way to get a bigger fill is to buy it a little expensive. And that is what we call as a pro gap, because this shows us that this might be a pro action because somebody was willing to buy a little expensive to have a bigger fill because the stock has already been very, very cheap. And yes, based on that definition, this is a pro gap for us. And since it is a pro gap, this is qualified for us. If this would have not been a pro gap, this would have got disqualified. Now, pivot non-authenticity is not applicable because we only apply pivot non-authenticity to a drop-based rally or a rally-based drop. Unstable equilibrium is also not applicable. So after applying all the applicable rules, is the zone qualified? The answer is yes, because whatever conditions were getting applied, the zone has been qualified for us. And now that we know we have a qualified zone, we still can't trade it blindly. The next step is the booster scoring. First one is freshness. The zone is definitely fresh. And that is why we also have the condition that it has to be an open gap. Because if it is not an open gap, it is already tested. An open gap means it is still a fresh area for us. Strength, a gap is always given a score of 2. Time at the zone, we only have one candle, gets a score of 2. And reward to risk ratio will take as an assumption, because unless and until we get closer to the zone, we don't know where the opposing zone would be, and based on that, our reward to risk ratio can change, and that is why currently we will take it as an assumption. Now, talking about location, if I go to the monthly time frame, you can see that we do have a monthly demand area. We are planning a trade inside of it, but no matter how far back I go, I don't have any supply. We have taken such scenarios in the past, and in that, what we do is, if we don't have a supply zone, we can use the most recent pivot high as a reference point and draw our curve. And based on this, now we have 4 divisions, not 5 divisions. We have high of the curve, we have middle of the curve, we have low of the curve, and we have very low of the curve. We do not have very high of the curve because my higher time frame supply zone is missing. So based on this, we are planning our trade very low of the curve, which is considered as the best location for planning a long trade. Therefore, we'll get a score of 2. Now at best location, trend becomes irrelevant. It doesn't matter whether I'm in an uptrend, downtrend, or sideways. You don't even have to do the trend analysis. We can straight away give it a score of 1. Move from the zone, we need a minimum 4:1, which has not yet happened. So currently a score of 0, but if the prices they eventually move up and then start coming back, this can upgrade to a score of 2. Next is level on top of level. We have already verified, not a case of level on top of level, not even coinciding. But for trap, we can give it a score of 1. And the reason for that is if I take a horizontal line, wherever the proximal is, zoom out and just start pushing it up, you can see that almost this area, if I bring in a little bit more history, has been acting like resistance, has been acting like support, has been acting like support. So we do have a pretty nice, neat area of support resistance. Now, people who believe in support resistance would be buying in this area with their stop losses placed below, and those stop losses will be sell orders. And similarly, if you get a breakout, then people who believe in breakout trading will also start selling, and these people are making two mistakes. Mistake number one, selling after a decline in price means they're selling at a cheaper price, and also selling in an area where the chart has proven to us that back in history, demand was more than supply, which could be the only reason for the prices to move up. So yes, we do have that possibility that this might work like a trap, because of which I'll give it a score of 1. So we have a high quality zone with the assumption of reward to risk ratio and high probability setup, and high quality, high probability can be done as a type 1 trade. So after applying the boosters, we got to know that this is a type 1 trade for us. Now, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we need to be ready for the worst case scenario, so that in case the trade does not go in our favor, it goes against us, we do not lose more than whatever our risk management rule allows us to lose. So we'll have to do proper position size calculation. Now, whenever the prices are back, we'll have to re-verify. If the trade is still qualified based on our trade plan, we place our order based on the entry type. And once your order has been executed, the last step is your trade management, where step 1 is 1:1. We make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule-based. And if these sessions are helping you with your trading, helping you understand demand supply methodology, I'll highly appreciate if you can hit the thumbs up button. And yes, if you're not subscribed to my channel, you can also subscribe to it. Keep the notifications activated so that whenever we do a session or we post a video, you people get notified for it. And yes, I would also like to add that if you have some friends, family members who are into trading, or if you're into some trading groups, you can share the link to my course content. You can share the links to these practical sessions. You can even share the link to that 7-day free trial that we are offering now, so that more and more people can take advantage of it. So let's see, what do we have in the chat box now? I think this method started from a very long time, very long ago. Is it still works? See, as long as demand supply economically works, which means if there is more demand, price will always go up, and if there is more supply, price will always go down. Then this methodology will work forever, right? The day the economics changes, that more demand does not necessarily mean price will go up, then maybe the methodology might stop working. But because it is based on that fact that more demand always makes the price increase and more supply always makes the price go down, the methodology will remain methodology which will work forever. And that is why I also call it as a universal methodology, because it is not just restricted to stocks. You can apply it to stocks, you can apply it to commodities, you can apply it to forex, you can apply it to cryptos, you can apply it to intraday trading, you can apply it to investing, right? It is a universal strategy which can be applied across the board, any markets, any asset class, any style of trading you want to do. It's been 8 months since I have been practicing this strategy. If I want to do this full time, do I have to do all HIT, DIT, WIT, MIT, or only WIT and MIT? See, again, it depends upon a lot of factors, right? One factor can be, let's say, your capital, right? Now, if you have very limited capital and you're only doing MIT trades, then the kind of returns you are getting might not be helping you, let's say with your monthly expenses. But let's say now if you have a very big corpus, then why do you have to get into HIT trades and DIT trades or WIT trades, right? You can do laid back trading, like I do. You can only get into MIT trades. But now if your capital is small, That is where you'll probably have no choice. You might want to get into some intraday trades to do some extra trades, more number of trades, and have a better return, because your number of trades can be a little higher. And plus, the other problem is that for intraday trades, you also get leverage. For MITs, you don't get leverage, so your capital also gets stuck. So that is where those decisions will be coming from. That what kind of capital you have, and plus also your risk appetite as well, right? So a lot of factors will help you decide that. But yes, what I'll say is, if you have a good enough capital, then why to get into a lot of noise, which is basically your HITs and DITs. But yes, there is nothing wrong with it. But I generally prefer, maybe it's my personality style, that is why I prefer MITs. But otherwise, I have done DITs in the past. I've also done WITs in the past. But now I'm more comfortable with the MITs. I do more of laid back kind of trading. All right. Will you in future be showing a crypto market or 24-hour market as an example for the explanation? See, the fact is, whatever I'm analyzing, it might have been a crypto chart, right? Doesn't make any difference. So it's not that if it is a 24-hour markets, anything will change as far as the analysis is concerned. The analysis part will remain exactly the same. The time frames will change, but the process remains exactly the same. But since I don't trade cryptos, I only trade the NSE market. I only share the examples from something which I've already shortlisted for me. So it's not that for these sessions I'm doing any extra homework. But if I'm looking into other markets, I'll have to do some extra homework. That is why probably that is not going to happen. I will always be sharing from whatever I've shortlisted for myself. And those are the examples which I share with you people. When re-verifying the trade, that then eventually open gap would be not valid since the price are coming back. So do we cancel the trade? See, again, if you think about it the other way as well, if you say, okay, I have a fresh zone, but when the prices come back into the zone, now it is no longer a fresh zone. Should I be skipping the zone? The answer is no. Right? We understand that the very first time prices are coming back into the zone, at that given point of time, the zone was fresh. So, example, if I have a zone, be that because of a gap or be that not because of a gap, when the prices are revisiting, this was a fresh area, right? But now it has been tested. So the second time when the price comes into the zone, it is already a tested zone. When the price is coming back for the very first time, it is coming back to a fresh zone, irrespective whether it was because of a gap or whether it was not because of a gap. All right. Will you be showing your trading setup as a long vlog video, something like trading setup tour? So see, generally, if you talk about my trade setup, most of the times I'm not even in front of my screen, right? So there is nothing to show. But yes, otherwise I'll just tell you, I have two monitors with me. On one monitor I have my trading view running, because that is where I do my analysis. But for placing my orders, I have a different broker which is running on my other screen. So what generally happens is that during the market hours, my computer is on the full volume because my alerts are set. So as soon as I get a notification, an alert, I just go back to my screen and check whether it is an alert for placing a new order because prices are coming into my zone, or whether it is an alert for modifying my trailing stop loss, or maybe it is an alert for that the profits have been booked. So again, most of the times I'll say, in fact, if you look at the 6 hours and 15 minutes, probably in 6 hours 15 minutes I'm in front of my screen, maybe for 10-15 minutes only, when I'm getting those notifications. Because the lesser you're watching the screen, the lesser you are ruining your trades, right? The more you're watching the screen, you tend to play with it, and the emotions, they at times take over, and you might exit a trade early. So I prefer not to be in front of the screen, only in front of the screen whenever I get those notifications. And that's how it is. All right, could you confirm which time frame is better for intraday trading? So again, Sunil, it is not about which time frame is better for trading, right? It's not that a 1 minute time frame is very good and a 10 minutes time frame is very bad. All time frames are good as long as you have a setup which is in sync with your trade plan. If you have something which is not in sync with your trade plan, then doesn't matter what time frame you're using, it has no meaning, right? But as long as you are having a trade plan for you, and that particular time frame is in sync, whatever opportunity you have is in sync with your trade plan, you can use a 1 minute chart, you can use a 10 minute chart. But yes, every time frame has its own pros and cons. Example, when you're doing trading on a very small time frame, example, let's say if I'm doing an HIT trade. Now as an HIT trade, my time frames are 60 minutes, 15 minutes, 5 minutes and 1 minute. So this is HIT. So this is my HTF, my ITF, ITF, LTF, and the RTF. Right now, if we compare it with a monthly income trade, MIT, my high time frame is monthly, then we have weekly, then we have daily, then we have 60 minutes. Now, if you think about it, as a early income trader, my curve analysis can change every 60 minutes. Why? Because every 60 minutes a new candle can form, which can create a new zone. So my curve analysis can change every 60 minutes. But as a monthly income trade, I know at least for a month, my curve analysis will not change. My trend analysis can change every 15 minutes. Here, at least for a week, the trend analysis might not change. My lower time frame zones, a new zone can form every 5 minutes, but here I know at least for the day the zone will remain valid. Only after the closing of the day I might have a formation of a new zone. So this is what happens. The smaller the time frames, the faster is the frequency of things changing. The bigger the time frame, the slower is the frequency of things changing. Right. So that is why when you're trading smaller time frames, you need to be more actively present in front of the screen because things are changing rapidly. That is the only challenge with smaller time frame, which again translates to intraday trading. Plus you also have to remember that both these traders, they need to have a very complete different mindset. An example can be that it is the same symbol ABC, whereas a monthly income trader, I might be planning a long trade which I'm expecting maybe will continue for X number of months. But on the same ABC script, when we are getting these corrections, I might have the opportunity to plan a short trade. But when I plan a short trade, I can't have that mindset that this short trade can continue for a number of days or a number of weeks or a number of months. As an early income trader, now I need to have that clarity. This short trade which I'm taking can only last for probably 60 minutes or maybe even less than 60 minutes. So as soon as I get my target, I need to exit, because if I don't do that exit, the next thing we realize is it might again start moving up. So, you need to have a mindset of an intraday trader when you're specifically planning intraday trades, because what happens is once a trade starts going in our favor, generally we get into that mindset, okay, now it's gonna just keep going in my favor forever. But remember, with smaller time frames, your job was not to be in a trade for a very long period of time. Your job was, okay, I am entering into the trade. As soon as it gives me my target, which might be 2 is to 1, 3 is to 1, 4 is to 1, whatever the chart was showing you, I need to exit now. And if you don't do that, at times those smaller time frame trades can go against you really, really bad. So that is where your mindset has to be very clear, that when you're trading intraday, you do not have to convert that intraday trade into an overnight trade, because an intraday trade which might be giving you a 5 is to 1, at times if you just keep it overnight, the very next day you might be minus 10 is to 1, right? So that can also happen. So always keep that in your at the back of your mind. So that is one challenge, that you need to have that understanding. Smaller time frames, faster the conditions are changing. Smaller time frames, I can't have a perspective that I just keep continuing with that trade and keep it for the next day or the next week. Once I'm getting my exits, I need to take those exits. And the next challenge also is that with the smaller time frames, your zones are generally very narrow. So even if you get a 2 is to 1 or a 3 is to 1 or a 4 is to 1, it might still take away 30%, 40% or 50% of your commissions if you're not trading with brokers which are providing huge discount. Right. So those are some of the challenges which you will be facing when you're doing intraday trading. But again, when it comes to time frames, all time frames are good as long as you have a setup which is in sync with your trade plan. Reward risk explain 5 is to 1. So if I'm talking about a 5 is to 1 reward to risk ratio, it basically implies, now if I just go back to my example for today. So in this example, you can see this is the risk I'm taking on this trade, right? So let's imagine I'm entering at 100 and my stop loss is 99. So I know I am taking a risk of 1 rupee on this trade. So a 5 is to 1 means that unless and until my opposing zone is at least 5 is to 1, which means if I'm risking 1 rupee, I can see a potential that if it goes in my favor, I can make at least 5 rupees on this trade. I will not enter that trade, right? So that is what a 5 is to 1 reward to risk ratio means, that wherever risk I took, I am seeing a target which is at least 5 times of it, right? So similarly, if I say a 2 is to 1 reward to risk ratio, which means whatever risk I'm taking, I need to see at least twice the reward on that trade. Otherwise, I'm not taking that trade. All right. So that answers that query. All right, so what's your thought on quick retest, quick hits evidence? Does it increase the probability of the trade setup? See, generally, if the zone is tested, you understand that a tested zone means that the orders are getting filled. But yes, if you talk about a quick test, if you talk about art boosters as well, right? That is also where we have talked about that if it is a shallow touch, it can still be traded, right? But in a way it definitely takes your probability a little lower because some of those orders have now been filled. But yes, those tests, if they are shallow touch, you're still okay with it. But again, a lot of other factors would also count. Now, just as an example, like I was talking about, HIT trade. Now, for an HIT trade, if I see something like that, probably I'll never take that trade because I know on a smaller time frame, anyhow, the number of orders might be very small, and a tested zone further reduces my probability. But on a bigger time frame, I might still be comfortable with that, right? So again, all these factors have to be think about what time frames you're trading and where your locations are. Now again, an example can be if the zone has been tested but I am planning a trade very low on the curve, I'm still okay with it, right? But if it is not very low on the curve, then I still need to be a little bit careful with it. And that is what I say, all these sessions, they help you understand different aspects of demand supply methodology, the pros and cons of different things which are happening. And that is why I always keep saying that do ensure that you attend multiple sessions. If you can't attend them live, at least watch the recordings, because from every other session you'll have something new to learn. But once you have gone through, probably I'll say 50, maybe 100 sessions, then there will be nothing new for you, because in one session everything can't be covered, right? So the more number of sessions we look into, we'll have different examples, and from different examples we'll learn different things. But once you have been through, like I said, 50 or 100 sessions, almost everything has been covered. That is when you'll have nothing new to learn. But yes, until then, keep joining these sessions. You'll start learning different pros and cons for different conditions which are happening in the market and on the charts, and based on that, then you can make a more informed decision. Like I just said, just a test. Yes, we already have it in our boosters. We can reduce the scoring of the zone, but we can still use it. But again, depending upon different aspects, what time frame it is, where it is located, I might take that trade, I might not take that trade. So all those things. See, again, if I put it in another way as an analogy, whatever we are talking about in demand supply methodology, different concepts, different quality boosters, probability boosters, all these things are more like small little pieces of puzzle. So what we are doing is we are trying to connect these small little pieces of puzzle to see the whole picture. And once we see the whole picture, then we make our decision whether this is something I want to participate in or something I don't want to participate in, based on your experience, based on what has happened with your trades in the past. And that is how we make our trading decisions. Or so how to contact you regarding indicators and details. So everything is available on our website. Otherwise, if you want to, if you have any questions, queries on our website, once you scroll down, you'll have contact us link available. You can click on that, and using that, you can send us an email with whatever information you require, and we'll definitely get back to you. All right, so that brings us to the end of today's session. Thank you so much for joining in. I will be seeing you now next weekend. Till then, trade safe. Enjoy your Saturday evening. Take care. Bye bye.